Billionaire entrepreneur Mark Cuban says that he's actually a big fan of what's playing out between retail investors and hedge funds around shares of GameStop. Users of Reddit's Wall Street Bets forum have helped bid that stock up massively this week. Last night, Cuban tweeted, "I've got to say I love what is going on with hashtag Wall Street Bets. All of those years of high-frequency traders, front-running retail traders, now speed and density of information and retail trading is giving the little guy an edge. Even my 11-year-old traded with them and made money." Mark, of course, as you know, is also the owner of the NBA's Dallas Mavericks, and he joins us right now on the Squawk Newsline. And Mark, I want to hear your thoughts on this, because I get it. I love the sentiment of being able to stick it to the hedge funds. And what the hedge funds have been able to do in some cases has been really, really bad news. But if you're manipulating market prices, I don't see how that's a good thing really in any scenario.
How is this any different than what every brokerage firm does? You know, we've been talking about get long, get loud for generations.
It's not good for the brokerages to be doing that at all either. I'm not defending that. It's just when you see moves like this, it's a little crazy. And I wonder what Doug Parker is thinking. I wish we could get him back on to ask him what he thinks about his stock being up better than 50%, because I would think that makes a company pretty hard to run, too. How do you live up to those expectations now?
Oh, but they're not expectations at all. I mean, look, the reality is you just have to run your company and do your best. It doesn't change the fundamentals of the company at all. You know, it so many respects is window dressing. And if you are an owner of American Airlines, if you're an owner of GameStop, hopefully, you know, prior to all this, hopefully you owned it for a good reason and you believe in the company. And all the not even manipulation, all the swings in the price of the stock, it's all just mishigas, right? I mean, if it's a good company, it's a good company. If it's a bad company, it'll end up going out of business. And, you know, the people who, you know, bought it just to speculate, some will make money, some will lose money. But that's just the way the market's always worked. The only thing that's really changed is the speed and the density and the reduction in friction for smaller traders to trade. That's the only thing that's changed.
Yeah, I mean, look, it's good news in terms of crowdsourcing, being able to have the same heft that some of these really big whales have on their own, if you can get this together. But we don't know who some of the people on the chat boards are, or in Reddit are on these threads who are saying some of these things, too. Do you worry that some of the Wall Street guys could get behind that, some of the big guys, and manipulate those things?
Yeah, but it's not really manipulation. It's absolutely no different than what has always happened, Becky. You know, it's just these folks are picking things where, you know, heavily shorted stocks. They'll go to low float stocks because they know they can flex and show off, you know, and let people see what's going on. But look at it the other way. What if they go after companies that are really good, or maybe smaller companies that are have a great social mission and get people not just to buy them in mass and quickly so the stock price skyrockets, but also to hold on to them, or, you know, in cryptocurrency terms, hodl them so that, you know, that company really can grow based off of the valuation of that stock. You know, so I think now it's just a flex. You know, they picked the right place to show off with these heavily shorted stocks. And, you know, hopefully they'll go to good companies too and help them grow. And we'll see a positive side of this that hopefully will have long-lasting effects.
Look, I think one thing this definitely does is shines a light on some of the behavior that regulators really should step in and take a look at, some of the behavior by the hedge funds. If you're able to short more than 100% of a stock, if you don't have to disclose your shorts ever, if you can do one thing and you know, say one thing and do another, I think that there could be a call for additional regulation coming on that. What are your thoughts there?
Well, I mean, if you're misleading, right, if you're pumping and dumping to the upside, or if you're shorting and misleading people to the downside, yes, that's obviously something the regulators should look at. But remember, when you short a stock, there's a vig on it, right? You have to borrow it, and you're paying some percentage to the whoever owns the stock and is loaning it out. And as someone who's shorted stocks many times, you know when that vig is high, you know exactly what you're getting into, and you know exactly what the risks are. You know, and you just hope something like this doesn't happen. But again, it's not the first time that low float or heavily shorted stocks have been targeted. It's just very visible, and it's just not the normal suspects that are doing the targeting. There are many hedge funds that have made a lot of money over the years targeting heavily shorted stocks. And so I don't think this is anything different. It's just the people who are making the push aren't who we expect them to be. And so that's why I like it. You know, when you bring people out of nowhere to really show the inefficiencies of the market, it's a good thing.
Mark, let me ask you this, though.
Sure.
We all talk about the market trying to be efficient, trying to be rational. Usually when people invest in things, they are hoping to make money. You have a group of people in this case, and this is the part that I'm just struggling with, who are effectively online saying, we don't care if we lose money. In fact, we expect to lose money as long as we, quote unquote, beat the hedge funds. And that's one group of people. But then there's another group of people who are riding on top of that, possibly professionals, but also possibly others, retail investors who actually need the money, like they need it to pay the rent. And maybe I'm a Pollyanna, and maybe people think that I'm trying to protect the little guy, and they think that by trying to protect the little guy, you're really trying to protect the hedge fund manager. But I'm grappling with this because I remember after the financial crisis, the media was blamed. The media was blamed for not blowing the whistle loudly enough. Now you blow the whistle, and the folks online say, we don't need the protection. How do you square all of this up?
Well, a couple things there. One, most people who spend their money on stocks these days are not investors, right? And most of the trades that are taking place are algorithmic. This is the days of, okay, give me a share. I gave my son or daughter a share of IBM, and I hope it's going to be worth 100 times by the time they're 30 years old. Those days are long gone. Right? More people just buy just to speculate and trade than actually invest. Now, if we want to talk about changing rules so that we really reward investing and buying and holding and, buying companies for their intrinsic value, that to me is a different discussion. But, as long as we're allowing companies to trade stocks in milliseconds, how can we expect this to be an investor's market? And until you change that, you can't change what's happening with Wall Street bets.
And I appreciate that. The question that I would ask, though, is do you look at the numbers, for example, on GameStop and say this is realistic, that there's a fundamental argument for a company being worth this company being worth as much as Best Buy, for example?
I think GameStop has a good chance of going out of business because all the trends are against them. But then again, I'll keep on going back to this, Andrew. I mean, when you allow when the average holding period is now in seconds instead of even minutes, we can't talk about investing. Investing, this is not investing, right? This is speculation and trading. And when we allow high-frequency traders to trade, to locate their servers, and use such advanced technologies that the only thing that they're looking for is to trade based off of speed ahead of others, we can't talk about investing. This is not an investor's market. Right? It's a technology-driven market, and in this particular case, the technology that matters more than speed and proximity is the lack of friction and the speed and the density of trades from individual traders like this.
Mark, do I keep hearing that we're seeing bad behavior, so you answer it with bad behavior, and there's a lot of wrongs in the markets right now, so you need to address those wrongs with more wrongs. I mean, when you look at GameStop...
No, that's not what I'm saying, Joe. That's not what I'm saying at all.
Graham and Dodd would be rolling over in their graves right now looking at where GameStop is valued. And as a way to stick it to the shorts, who are elitists and who have been gaming the system for so long, it just seems like you're justifying it, and two wrongs don't make a right.
No, that's not what I'm saying at all. I'm saying these are the rules that we have set. And when you have given rules, then you have to be willing to accept the behavior that those rules enable. If you want to change the rules and say, okay, you got to have a one-day holding period for any stock, you're going to have more investing and less speculating. Now, some people might argue the market becomes less efficient, but at the same time, you're going to gear that market back towards investing. And Mark, so if you're going to set these rules, you've got to live with the consequences.
With all this stuff, SPACs, IPOs, GameStop, going up, whatever, I've lost track, 4,000%, whatever it is. Any of this have you worried about the Fed or the overall environment that we're in right now?
Of course, I hedged the heck out of my portfolio. Absolutely, it has me worried. Because, when you've got such low interest rates, and we're seeing speculation everywhere because as assets, as have inflated, you've seen it across a whole range of assets, whether it's cryptocurrency, whether it's trading cards, whether it's, non-fungible tokens, whether it's housing. When you've got such low interest rates, you're going to get appreciable assets inflating. And so it creates a lot of concern, because when interest rates, if and when they do go up, and who knows whether it's, years or decades when we'll see 4 or 5% interest rate again, then people will have different decision criteria, and that will certainly deflate. I don't want to call it a bubble because it's reality given the interest rates, but there'll be a deflation of some sort in those appreciable assets, and it's going to be scary when that happens.
Hey, Mark, would you feel any differently about this if the crowdsourcing that was taking place was kind of taking a bear turn on this and sicking shorts after people?
No, not at all. I mean, to me, when someone shorts a stock that I own, it's a beautiful thing, right? Because if the company does well, then they're going to have to buy that stock back at some point. Now, of course, there's certain circumstances where if the company's trying to do a secondary or raise money, and that diminishes their ability to do that, and that makes it a bad thing. But more often than not, if the, I always looked at it as, please, short my stocks, because I'm trying to invest in good companies, and if they perform, at some point they'll have to buy them back.
Your point on what the regulators need to address is an interesting one, this idea of having a longer holding period. I think the average holding time is like 40 seconds or something stupid right now.
Yeah,
what other things do you think they should be looking after, aside from just making a longer holding period?
I haven't given it a lot of thought, so I don't have a good answer for you. But, we have to decide what we want in our market. Do we want this just to be an open, this is just a very liquid market, and here are the rules, and whatever comes along, we deal with it? Or do we want to encourage investing again? And you do that through the restrictions, right? I mean, you can talk about taxing, and I know that I forget the exact name for taxing trades, but if you're going to tax a trade that's held for less than a minute, I think that's not necessarily a bad thing to consider. That freaks out a lot of people, but I think we become stronger as a country when we have investors rather than traders, and even stronger when those traders are not algorithmic, because that, as we go forward with AI, and AI gets more advanced, and natural language processing gets more advanced, and we use more sources as inputs for those trades, we're going to have, there's going to be other times when we get significant moves one way or the other in a stock or a group of stocks that we can't explain. And, this could be even worse. And because we won't know who's behind it, or even why these black boxes, these neural networks are making these trades. And so if we don't make the conscious decision legislatively to say, look, we want to have investors rather than traders. And I get the argument that all these algorithms create liquidity, and that makes it easier. And these things couldn't happen. Wall Street bets couldn't do what they did unless there were algorithms, balancing liquidity. I just don't think that matters, right? I don't think liquidity is the ultimate goal of a market of stocks.
Mark, you just said we need to get back to investing. We need to make it so that people start investing again. And then in the same breath, you're like, but I really like what's going on here with this chat room stuff, running these things up 8,000%. I just don't see how you can say both. If we want to get back to that, just answering the status quo with even more insane logarithmic moves in these, I don't see how that helps when our goal is to get back to 401k, that stocks over time are a way of building wealth for your family and for your financial future.
The rules, it's like changing the rules in the NBA or the NFL for pass interference, right? Or replay for pass interference. Whatever the rules are, people are going to try to use them to their advantage. Okay. And so the way the rules are right now, this is what we should expect. There's nothing that's out of the ordinary with what we're seeing right now. It's just, the natural culmination of the way the rules are written. And so if we want to get back to investing, then we have to change those rules. So as long as we don't change the rule book, great. I'd rather see the little guy start to have an impact than only, big brokerages or big hedge funds. And look, every single day there's a call made at a major brokerage where they go out and tell their brokers, who then go out and tell their clients. And you've got brokerage firms with, millions, if not tens of millions of clients who try to do the same thing. They go out on the Squawk Box and they make a call and they hope as many of their customers as possible will jump into that stock. This is just a lot faster and in a similar version.
I just think way too much speculation. But while I got you here, the Lakers tonight, will they cover with the 9.5 over the Pistons? Do you think?
I don't know if I'm going to buy any GME today. I'll have to make that decision later.
Give me a sure bet for tonight. Give me one sure bet for the Trailblazers, Rockets, Clippers, Heat, Warriors, Suns.
Order a pizza, you'll enjoy it. That's a sure bet.
All right.
Mark, we got to go, but real quickly, you said your 11-year-old traded some stock. What do you make money on?
He bought 2 shares of BlackBerry and 2 shares of AMC. And I had made him tell me why he liked those stocks. But let me just tell you, he got all his information off of TikTok. Every bit of it he got off of TikTok, and that's why he was aware of those stocks.
Brand new world.